Before we dive in, it is critical to understand that this presentation is for informational and educational purposes only. I am not a licensed financial advisor or insurance agent, and the information provided in this video should not be considered legal or financial advice. Insurance policies are complex contracts, and your individual needs will vary. Always consult with a qualified, licensed professional in your state to discuss your specific circumstances before making any insurance decisions. Florida has the most expensive car insurance in the entire United States. That's not an opinion, it's a fact. The average driver in the Sunshine State pays a staggering 42% more than the national average. More than a driver in Los Angeles dealing with 6 lanes of gridlock. More than a driver in New York City navigating a sea of yellow cabs. You are paying a premium price, and chances are you feel it every single month. Picture this, because I know this has happened to you. The renewal notice for your auto insurance arrives in the mail. You feel that little pit in your stomach as you tear it open. You haven't had a single accident. Not one ticket. Your car is a year older, it's worth less, not more. Yet, when you look at that number, that premium, it's gone up. Again. Another $100, another $200 for the 6-month term. You throw your hands up in the air and ask the empty room, how is this possible? What did I do wrong? I'm here to tell you, you did nothing wrong. You are playing a game where the rules are confusing, the goalposts are always moving, and the other team seems to own the stadium. But what if I told you that you can learn the playbook? What if I told you that by the end of this video, you will understand exactly why your rates are so high and, more importantly, you will have a concrete, actionable battle plan to lower them significantly. This isn't about finding some magical, one weird trick. This is about empowering you with knowledge. It's about pulling back the curtain on the Florida insurance industry, so you can navigate it like a pro. We are going to transform you from a frustrated consumer into a savvy shopper who knows exactly what they need, what they don't, and how to get the absolute best price for it. So why? Why is it so expensive to drive in a state famous for sunshine and beaches? It's a perfect storm of 4 key factors. First, Florida is a no-fault state. We're going to break that down in a minute, but in simple terms, it means your own insurance has to pay for your initial medical bills after an accident regardless of who caused it. This leads to our second problem, rampant fraud. Dishonest medical clinics and attorneys exploit this no-fault system, creating fake or exaggerated injury claims that cost insurance companies billions, a cost they pass directly on to you. Third, we have a legal environment that's, let's call it, friendly to lawsuits. Florida has a massive number of attorneys who specialize in auto accidents, and the high volume of litigation drives up the cost for everyone. And finally, there's the delightful Florida cocktail of risk. Hurricanes that cause widespread vehicle damage, torrential rainstorms that lead to accidents, a huge number of tourists on unfamiliar roads, and unfortunately, one of the highest percentages of uninsured drivers in the country. When someone without insurance hits you, your own policy often has to pick up the tab. It's a system that feels stacked against you, and in many ways it is. But here's the good news. Within that broken, expensive system, there are massive opportunities for savings. The insurance companies are not going to call you up and offer you the best deal. They're not going to volunteer information about discounts you qualify for. You have to be your own advocate. You have to know what to ask for. Over the course of this guide, we are going to walk you through everything. We'll start with the absolute basics. The minimum insurance Florida law says you must have to legally drive your car on the road. It's probably less than you think, and understanding it is the foundation of building a smart policy. From there, we'll demystify all the other coverages. What is bodily injury liability, and why is it arguably the most important coverage you can buy, even though it's not always required? What's the difference between collision and comprehensive, and do you really need both? We'll explain it all in plain English with real-world examples so you can finally understand what you're actually paying for. Then we'll get to the fun part, the strategies. We'll show you how to shop for quotes the right way, using a specific method that forces companies to compete for your business. We'll reveal the discounts that most people miss, from low-mileage programs to professional associations to simple adjustments in your payment plan that can save you real money. We'll talk about your credit score, your zip code, and even the type of car you drive, and how each of these factors is a lever you can potentially pull to lower your premium. Let's start with the absolute bedrock of Florida auto insurance, the no-fault law in personal injury protection, or PIP. This is the concept that confuses people the most, and it's the primary reason our system is so different. In most states, if someone rear-ends you, their insurance company pays for your medical bills and your car repairs. It's simple. The at-fault party pays. But not in Florida. Our no-fault law was designed with a noble goal: to reduce lawsuits over minor injuries, and to make sure that anyone hurt in an accident could get immediate medical care without having to wait for a long, drawn-out process of proving who was at fault. The way it works is through your own personal injury protection coverage. By law, every single driver in Florida must carry a minimum of $10,000 in PIP coverage. Think of it as your own personal health insurance fund specifically for car accidents. If you are injured in an accident, it doesn't matter if you caused it, if the other driver caused it, or if a flamingo flew into your windshield and caused you to swerve, your own PIP coverage is the first to pay. It covers you, relatives who live with you, and anyone driving your car who doesn't have their own PIP. It even covers you if you're a pedestrian or cyclist and you're hit by a car. This PIP coverage will pay for 80% of your initial medical bills. That includes the ambulance, the emergency room, doctor's rehab, whatever is medically necessary, up to that $10,000 limit. It will also cover 60% of any lost wages if a doctor says you're unable to work because of your injuries, also up to that $10,000 limit. Now you might be thinking, $10,000? That's it? An ambulance ride and a few stitches can cost that much. And you are 100% correct. That $10,000 limit is exhausted incredibly quickly in today's medical world. This is a critical point to understand. PIP is designed for initial and relatively minor medical expenses. It is not designed to cover a catastrophic injury. Here's the catch, and it's a big one. To get the full $10,000, the state says you must seek medical treatment within 14 days of the accident. If you wait until day 15, your PIP benefits are gone. Poof, vanished. You get nothing. Furthermore, to be eligible for the full $10,000, a doctor must diagnose you with an emergency medical condition. If your injury is determined to be non-emergency, your PIP benefit is slashed from $10,000 down to just $2,500. This is a huge source of confusion and frustration for people after an accident. So, the first piece of the puzzle is this mandatory $10,000 in PIP. The second piece of mandatory coverage is property damage liability, or PD. You must also carry a minimum of $10,000 of this. While PIP covers injuries to you, property damage liability covers damage you cause to other people's property. This is your classic at-fault coverage. If you lose control and hit your neighbor's mailbox, your PD pays for it. If you rear-end someone at a stoplight and crumple their bumper, your PD pays to fix their car. And that's it. Legally, to register a car and get a license plate in Florida, all you need is $10,000 in PIP and $10,000 in property damage liability. That's the bare bones state minimum policy. And when you see those ads for unbelievably cheap car insurance, this is the policy they are quoting you. It fulfills your legal obligation. But, and this is the most important, but you will hear today, it leaves you terrifyingly exposed to financial ruin. Let me explain why. Imagine a guy named David. He's 28, lives in a nice apartment in Tampa, works in IT. He's smart with his money. He comparison shops for everything, uses coupons, and has a spreadsheet for his budget. When he bought his used Honda Accord, he did what any financially savvy person would do. He shopped for the cheapest possible car insurance that was still legal. He found a policy online for a rock-bottom price. It had $10,000 in personal injury protection, or PIP, and $10,000 in property damage liability, or PDL. He checked the box, paid the premium, and felt a sense of accomplishment. He just saved himself $80, maybe $100 a month. He was a winner. One Tuesday morning, he's driving to work on the Howard Franklin Bridge. Traffic is its usual stop-and-go mess. He's listening to a podcast, maybe a little distracted. The car in front of him, a brand new Lexus SUV, slams on its brakes. David reacts a second too late. It's not a high-speed crash. It's a classic low-speed rear-ender. The crunch of metal is sickening. Airbags deploy. Everyone is shaken up but seems okay. The driver of the Lexus, a woman in her 40s, is complaining of neck pain, but she's walking and talking. David does everything right. He calls 911. He exchanges information. He calls his insurance company and opens a claim. He thinks to himself, "This is a nightmare, but thank God I have insurance. This is what I pay them for." He feels a sense of relief. That relief lasts for about 2 weeks. That's when the first letter arrives. It's from his own insurance company. They inform him that the damage to the Lexus SUV has been assessed. The rear bumper, the trunk, the taillights, the backup sensors. The repair estimate is $22,000. The letter then politely reminds him that his property damage liability limit is $10,000. They have paid out that full amount to the other driver's insurance company. The letter concludes by informing him that he is personally responsible for the remaining $12,000. David's blood runs cold. $12,000. That's a huge chunk of his savings. But he thinks, okay, I can set up a payment plan. I can handle this. It's a painful, expensive lesson, but I can survive it. Then the second letter arrives. This one isn't from his insurance company. It's from a law firm. A big one with a fancy logo on the letterhead. The letter is from the attorney representing the woman he hit. It details her injuries: whiplash, a herniated disc in her neck, and persistent headaches. It lists her medical expenses so far: an emergency room visit, an MRI, multiple consultations with specialists, and ongoing physical therapy. The bill is already over $30,000 and climbing. And here's the key part. The letter informs David that they are suing him. Not for $30,000. They are suing him for her medical bills, for her lost wages because she can't work, and for her pain and suffering. The total amount they are demanding is $250,000. David's world stops. He rereads the letter, his hands shaking. He immediately calls his insurance company, his voice trembling with panic. He says, "I'm being sued. You have to help me. This is what I pay you for." And the person on the other end of the line, the claims adjuster, says something that shatters his entire financial future. The adjuster says, "Sir, I'm sorry, but your policy doesn't have bodily injury liability coverage. We can't help you with this lawsuit. You're on your own." This story isn't a scare tactic. It's a Tuesday morning in Florida. It happens every single day. David isn't a bad driver. He's a normal person who made one simple logical mistake. He trusted that the legally required minimum insurance would actually protect him. It didn't. In Florida, it's designed not to. Let's break down that state minimum policy David bought. It has two parts. First, the $10,000 in personal injury protection, or PIP. This is the part of Florida's no-fault law. Here's what it does. It pays for 80% of your medical bills and 60% of your lost wages, up to a maximum of $10,000, no matter who caused the accident. Notice the word I keep emphasizing, your. David's PIP coverage helps David with his own minor injuries. It does absolutely nothing for the woman in the Lexus he hit. Her injuries are her problem, or more accurately, they are now his problem. The second part is the $10,000 in property damage liability, or PDL. This is the coverage that pays for the property you damage in an at-fault accident, typically, the other person's car. $10,000. I want you to stop and think about that number. Look around you the next time you're in traffic. The average price of a new car in the United States is now over $48,000. A new Ford F-150, the most popular vehicle in the country, starts at $36,000 and goes up fast. A Tesla Model 3? $40,000. A Honda CR-V? $30,000. That $10,000 limit might not even be enough to repair a car after a moderate accident, let alone replace it if it's totaled. As David discovered, that $10,000 limit is a drop in the bucket. It's an insult to the reality of modern vehicle costs. But here is the single most dangerous, most misunderstood part of Florida's minimum insurance law. Look at what's missing. What was the one coverage the claims adjuster told David he didn't have? Bodily injury liability. Let's call it BI. Bodily injury liability is the coverage that protects you, your savings, your home, your future income. When you are at fault in an accident and you injure or kill someone else, pays for their medical bills, pays for their lost wages. It pays for their pain and suffering. It is, without a doubt, the most important coverage you can have on your auto insurance policy. And Florida is one of only 2 states in the entire country that does not require it. Let that sink in. The state of Florida legally allows you to operate a 2-ton metal machine at high speeds without carrying a single dollar of coverage for the human beings you might injure. When you buy that cheap state minimum policy, you are making a bet. You're betting that you will never, ever make a mistake behind the wheel. You're betting that you'll never glance at your phone for a split second. You're betting you'll never get distracted by something on the side of the road. You're betting that you'll never cause an accident that hurts another person. Because if you lose that bet, you lose everything. The insurance company that sold David that policy fulfilled their legal obligation. The state of Florida said it was okay. But it was a financial time bomb. David's future is now a nightmare of lawyers, court dates, and wage garnishments. His dream of buying a house is gone. His savings are gone. His financial life is effectively over for the next decade. All because he tried to save $100 a month. All because he bought a policy that was legally sufficient but morally and financially bankrupt. This is the dirty little secret of cheap Florida car insurance. The great deal you see advertised online is often just a repackaged version of this bare-bones, legally minimum policy. It's a trap baited with a low price tag. It gives you a false sense of security. It gives you a piece of paper that lets you legally drive, but it offers you no real protection from the single greatest risk you face on the road: the financial devastation of injuring another person. So if the state minimum is a financial death trap, what's the actual minimum you should carry to protect yourself and your family? What are the specific coverages and the dollar amounts that separate a useless policy from a shield that can actually save you from ruin? That's what we're breaking down next. Let's start with a number that should scare every single driver in Florida: $100,000. That's a conservative estimate for the medical bills from a single moderately severe injury in a car accident. One broken leg, a few days in the hospital, some surgery, and follow-up physical therapy. $100,000. Now, remember that state minimum personal injury protection, or PIP, we talked about? Covers $10,000. That leaves you with a $90,000 hole. And that's just for your injuries. What if you're the one who caused the accident? Imagine this scenario. You're driving home on a 95. Traffic is heavy but moving. Suddenly, the car in front of you slams on its brakes. You react, but the person behind you doesn't. You're hit from behind, pushed into the car in front. It's a 3-car pileup, and because you were the car in the middle that hit the car in front, the police report says you're at fault for that front-end collision. The driver of that car, a late-model SUV, is complaining of neck and back pain. Their passenger is too. Your car is crumpled front and back. Airbags deployed. It's a total loss. If you only have Florida's minimum coverage, here's what happens next. Your $10,000 PIP coverage will go towards your own initial medical bills. It'll be exhausted almost instantly. Your $10,000 property damage liability will go towards repairing that SUV you hit. But a new front bumper, grille, headlights, and hood on a modern SUV can easily cost more than $10 grand. Let's say the repair bill is $15,000. You are now personally on the hook for that extra $5,000. But that's the smallest of your problems. The driver and passenger of that SUV you hit? They're lawyering up. Their medical bills are climbing. They're claiming lost wages. They're suing you. And what coverage do you have for their injuries? With a state minimum policy, zero. Absolutely nothing. Florida doesn't require bodily injury liability. So every single dollar of their medical bills, their pain and suffering, their lost income, it all comes after you personally. Your savings, your home, your future wages. They can garnish your paycheck for years. All because of a split-second accident and a policy that offered no real protection. This is why the first and most critical addition to your policy is bodily injury liability, or BI. This is the coverage that pays for injuries to other people when you are at fault. This is your shield. So what's the right amount? Forget the state minimums that some other states have. In Florida, we're not playing around. The absolute bare minimum you should consider is what's called 100/300. That means your policy will pay up to $100,000 for a single person's injuries, and up to a total of $300,000 for all injuries in a single accident. The next number in that sequence is property damage, and you should have at least $100,000 for that too. So 100/300/100. Write that down. This is your new baseline. With a 100/300 policy in our I-95 scenario, your insurance company is now on the hook for those injuries up to the limits. They provide the lawyers. They handle the settlement. You're not facing financial ruin. You're protected. Is it more expensive than a policy with no BI? Of course. But the alternative is gambling your entire financial future every time you get behind the wheel. The difference in premium might be $30, $40, maybe $50 a month. Is it worth $50 a month to not have your life destroyed by one bad day on the road? The answer is an undeniable yes. But we're not done. We've protected ourselves from being sued, but what about protecting ourselves from the other guy? What happens if the person who slammed into you from behind, the one who actually caused the whole chain reaction, has no insurance? Or they have the pathetic state minimums from their own state? This is where the single most important coverage for a Florida driver comes into play. Uninsured and underinsured motorist coverage, or UM. Florida has one of the highest rates of uninsured drivers in the entire country. More than 1 in 5 drivers on the road with you right now has zero insurance. Let that sink in. The person texting in the lane next to you, the one who just ran that yellow light. There's a 20% chance they have absolutely nothing to pay for your injuries if they hit you. Your PIP will be gone in a flash. Your health insurance might cover some things, but it comes with huge deductibles, copays, and it won't pay you for lost wages or for the pain and suffering of a life-altering injury. Uninsured motorist coverage steps in and acts as the other driver's insurance when they have none. It pays for your medical bills, your lost wages, your suffering. It is your financial bodyguard. And you should match it to your bodily injury liability. If you have 100/300 in BI, you should have 100/300 in UM. It's that simple. And here's a pro tip. Always ask for stacked UM. If you have more than one car on your policy, stacked coverage allows you to combine the UM limits from each car. So if you have two cars with 100/300 stacked UM, you effectively have 200 to 600 in coverage if you're hit by an uninsured driver. It's a powerful multiplier for a very small increase in your premium. Do not let an agent talk you out of this. Do not sign the form that rejects this coverage. It is, without question, the best investment you can make on your auto policy in the state of Florida. Okay, so we've covered liability and protecting ourselves from the uninsured. We're shielded from financial ruin. But what about your car? In our 95 nightmare, your car was totaled. If you only have the state minimums, you get nothing. $0. The bank that you have a loan with, they still want their money. So you're left with no car, and a car payment for a vehicle that's now a cube of scrap metal. This is where the physical damage coverages come in, collision and comprehensive. They're often sold together, and if you have a loan or a lease on your car, they're required. But even if you own your car outright, you need to think long and hard before skipping them. Collision coverage pays to repair or replace your car if it's damaged in an accident with another object, like another car or a pole, regardless of who is at fault. Comprehensive, or comp, covers almost everything else. Theft, fire, vandalism, hitting a deer, a tree falling on your car, a hurricane flooding it. People with older cars often think, my car isn't worth much, I'll just drop collision and save the money. This is a huge mistake for most people. Ask yourself this question. If your car was totaled tomorrow, could you comfortably go out and write a check for $5,000, $10,000, or $15,000 to buy a reliable replacement without causing yourself financial stress? If the answer is no, you still need collision and comprehensive coverage. The value of the coverage isn't just about the check you get. It's about maintaining your ability to get to work, to live your life, without being forced into a devastating, unexpected expense. You can manage the costs by choosing a higher deductible, say $1,000 instead of $500. This lowers your premium but keeps that vital protection in place for a catastrophic loss. So let's recap our new genuinely protective policy. We have bodily injury liability of at least 100/300. We have property damage liability of at least 100,000. We have matching uninsured motorist coverage of 100/300, and we made sure it's stacked. We still have our required PIP, and we've added collision and comprehensive with a deductible we can afford. This is no longer a piece of paper to satisfy the DMV. This is a real shield. This is a policy that lets you sleep at night. But building the right policy is only half the battle. Now we have to figure out how to get this level of protection without paying a fortune. Because let's be honest, that's the real trick, isn't it? Finding the discounts, understanding the rating factors, and knowing which companies are best for which types of drivers. Most people overpay because they don't know the inside secrets of how insurance companies actually calculate your price. They don't know about the hidden discounts they qualify for, or how a tiny tweak to their profile could save them hundreds of dollars. So let's pull back the curtain. The first thing you absolutely must understand is that your insurance premium isn't just a random number an agent pulls out of a hat. It's the result of a complex calculation based on dozens of what are called rating factors. Think of it like a recipe. Your personal information, your car, your driving history, these are all ingredients. The insurance company has a secret recipe that combines these ingredients to cook up your final price. And the most shocking part? Some of the most heavily weighted ingredients are things you probably never even thought were related to driving. Let's start with the big one, the one that makes people's jaws drop when they find out how much it's costing them: your credit score. Yes, your credit score. In the state of Florida, and in most other states, it is perfectly legal for auto insurance companies to use a credit-based insurance score to help determine your premium. And they don't just glance at it, it is a massive factor. You could have a spotless driving record, no accidents, no tickets, but if your credit is poor, You could be paying hundreds, even $1,000 or more per year than an identical driver with excellent credit. Why? The insurance industry will tell you it's all about statistics. Years and years of data, they claim, show a direct correlation between how a person manages their finances and how likely they are to file a claim. Their logic is that someone who is financially responsible, pays bills on time, manages debt well, is also more likely to be a responsible driver, to maintain their vehicle properly, and to be less likely to file small, questionable claims. Whether you agree with that logic or not is irrelevant. It's the reality of the system we're in. It's a risk assessment tool. Imagine two people, we'll call them David and Maria. Both live in Tampa. Both are 35 years old. Both drive the exact same 2021 Honda Accord. Both have a perfect driving record. Not a single ticket or accident to their name. On paper, they are the same exact risk. But David has a credit score of 580, while Maria has a score of 780. When they get quotes from the same insurance company, David is quoted a premium of $3,000 a year. Maria is quoted $1,800. That's a $1,200 difference for the exact same coverage on the exact same car for the exact same driver profile. The only significant difference was their credit history. This happens every single day in Florida. People are being penalized not for how they drive, but for how they manage their money. So what can you do? First, know your score. Get a copy of your credit report. You can get free ones annually, and check it for errors. A single mistake, a single account that isn't yours, could be costing you a fortune. Second, work on improving it. Paying your bills on time every time is the single most important thing you can do. It won't change overnight, but establishing a pattern of responsible payments will raise your score, and in turn, lower your insurance premiums over time. The next secret ingredient in their pricing recipe is just as powerful and often even more frustrating: your zip code. Where you park your car at night can have a more dramatic impact on your insurance rate than a speeding ticket. This is especially true in a state as diverse as Florida. Insurers are all about localized risk. They slice the state up into thousands of tiny territories, sometimes just a few square blocks, and they analyze the claim data for each specific territory. They're looking at things like population density. More cars on the road means a higher statistical probability of accidents. They're looking at crime rates, specifically auto theft and vandalism. If you live in a zip code in Miami-Dade with a high rate of stolen vehicles, your comprehensive coverage is going to be significantly more expensive than for someone in a quiet suburb of Ocala. Even if you personally have a locked garage and a state-of-the-art alarm system, you are paying for the risk of your neighbors. They look at the frequency of weather-related claims, like flooding or hail, which is a huge deal across Florida. They even look at the litigation rates in your area. Are people in your county more likely to hire a lawyer and sue after an accident? If so, the insurance company builds that potential legal cost into the premiums for everyone in that zip code. It feels incredibly unfair, and in many ways it is. You might be the safest driver in the world, but if you move 2 miles down the road into a different zip code, you could see your insurance rate jump by 30 or 40% overnight. I once spoke to a woman who moved from a suburb in Jacksonville to a neighborhood closer to the city center. Her commute got shorter, but her insurance bill went up by $80 a month. Why? Her new zip code had a higher accident frequency and more theft claims. She hadn't changed, her car hadn't changed, her driving record hadn't changed. But her address did, and that was all that mattered. While you can't always just pick up and move for cheaper insurance, being aware of this factor is critical. If you are planning a move within Florida, getting an insurance quote for your potential new address should be as important as checking out the local schools or the property taxes. Now let's talk about the car itself. And this goes way deeper than just the sports car costs more than a sedan. Every single year, make and model of a car is assigned what's called an ISO rating, or Insurance Services Office rating. It's a score based on a vehicle's claims history. Insurers look at how much it costs to repair that specific car. A popular family SUV might seem like a safe bet, but if it's loaded with expensive sensors in the bumpers for its lane assist and automatic braking features, a simple fender bender can turn into a $5,000 repair bill. The insurance companies know this, and they price the collision coverage accordingly. A simpler, more basic vehicle with cheaper parts might cost far less to insure, even if its sticker price was similar. They also look at the car's safety record. How well does it protect occupants in a crash? Better safety ratings can lower the cost of your personal injury protection and medical payments coverage. But here's the flip side. They also look at how likely your specific model is to be stolen. Certain models of cars and trucks are hot targets for thieves, especially in major metro areas like Orlando and South Florida. If you drive one of these high-theft vehicles, your comprehensive coverage rate will be higher, period. It's why a brand new flashy muscle car might, in some cases, be cheaper to insure than a 10-year-old popular pickup truck that is a prime target for theft rings. Before you buy your next car, you should be thinking like an insurance underwriter. A little bit of research into a car's repair costs and theft rates can save you thousands of dollars over the life of the vehicle. Finally, let's touch on a few personal characteristics that quietly influence your rates. Things like your marital status and even your occupation. Statistically, insurance data shows that married individuals file fewer claims than single individuals. Again, it's a risk calculation. They see marriage as a sign of stability and responsibility, which they believe translates to safer driving. If you recently got married, you need to call your insurance agent immediately. Don't wait for the renewal. This is a life event that can trigger an immediate and significant discount. Your occupation can also play a role. Some insurers offer discounts for certain professions that they deem to be lower risk. Fields like teaching, engineering, science, and first responders are often seen as being filled with more cautious and detail-oriented individuals. It may not be a huge discount, but in a state as expensive as Florida, every single dollar counts. It's another piece of your personal puzzle that you need to make sure your insurer has correct. Understanding these hidden factors, your credit, your zip code, your specific vehicle model, your personal life details, is the first major step toward taking control. It's about knowing the game being played. These are the core building blocks of your premium. They explain the why behind that shocking number on your bill. Now that you understand how they price you, we're going to turn the tables. We're going to use this knowledge to our advantage and start actively hunting for savings. I'm going to show you the exact list of discounts you need to ask for by name, the discounts your agent might not volunteer, and the ones that AI-powered quote websites can easily miss unless you know precisely what to look for. Let's break this down into 3 categories: the obvious, the overlooked, and the obscure. We'll start with the obvious ones, but I guarantee there's a detail in here you're missing that's costing you money. First up, the classics. The good driver and good student discounts. Everyone's heard of them, but the devil is in the details. The good driver or safe driver discount isn't just about not having accidents. In Florida, it's also about avoiding moving violations. A single speeding ticket can knock you out of this category for 3, sometimes even 5 years. You need to ask the agent for the specific criteria. What is their exact definition of a chargeable accident? What's the dollar threshold for damage? How many years do you need to be clean? Knowing their rules is the first step to playing their game. For the good student discount, don't assume it's just for your teenager in high school. Many insurers extend this to full-time college students up to age 25. The typical requirement is AB average or a 3.0 GPA. But here's the pro tip. If your student is on the dean's list or in the top 20% of their class, mention that specifically. Some companies have an even better tier for high achievers. Have a digital copy of their most recent report card or transcript ready to email over. Don't just say they're a good student, prove it. Next, the king of all discounts. Multi-policy, also known as bundling. This is the one discount that can single-handedly slash your premium by up to 25%. But people stop at the obvious: home and auto. Think bigger. Do you have a renter's insurance policy? Bundle it. A motorcycle? Bundle it. A boat? An RV? Bundle it. Even a life insurance policy or a personal umbrella policy can often be bundled for a massive discount. Insurers give you their best rates for this because it makes you a sticky customer. The more policies you have with them, the less likely you are to leave. It's a pain to move one policy. It's a nightmare to move 5. Use that to your advantage. When you bundle, you're not just a customer. You're an investment for them. And that gives you leverage. Now let's move to the second category. The overlooked discounts. These are the ones that are readily available but people simply forget to ask. Topping this list is the defensive driving course discount. This is huge in Florida. By completing a state-approved course, which you can often do online in a few hours for about $25, you can earn a mandatory discount on your insurance for 3 full years. The return on investment is astronomical. You spend $25 to save potentially hundreds. Ask your agent for a list of Florida-approved courses. It's a no-brainer. The next overlooked area is your vehicle's safety and anti-theft features. This is where online quote forms often fail you. They might have a checkbox for anti-lock brakes, But that's just scratching the surface. You need to be your car's advocate. Does it have daytime running lights? That's a discount. Electronic stability control? Discount. Passive restraint systems? That's a fancy term for automatic seatbelts or airbags. Discount. What about anti-theft? Don't just say you have an alarm. Is it a passive system that arms itself automatically? Or an active one you have to press a button for? Is there a VIN etching on the windows? Do you have LoJack or another vehicle recovery system? Make a detailed list of every single safety and security feature your car has before you get a quote. Think of it as your car's resume. The better it looks, the less you pay. Then there's the low mileage discount. In the age of remote work, this is more important than ever. If you drive less than the average Floridian, you should be paying less. The magic number is often around 7,500 miles per year. If you're under that, you need to shout it from the rooftops. Don't estimate. Go check your odometer from last year's service records and calculate your actual annual mileage. If you're a two-car household and one car is primarily for weekend errands, that car could qualify for a massive pleasure use discount. Be precise about how you use each vehicle. And one of my favorites in the overlooked category, affinity group discounts. Insurance companies make deals with large organizations to offer their members special rates. Are you a teacher? A nurse? A firefighter? A police officer? An engineer? There are discounts for you. Are you active duty military or a veteran? Huge discounts. A member of a specific credit union, an alumni association, a professional organization like the Florida Bar or a Realtors Association, or even a wholesale club like Costco or BJ's. Ask, by name, do you have a discount for members of your group? Don't wait for them to ask you. This alone can save you another 5 to 15%. Finally, let's dig into the third category, the obscure discounts. These are the deep cuts, the ones that separate the amateurs from the pros. They're small, but they stack up. First, the simple ones, paperless billing and autopay. You can get a small discount, maybe $5 or $10 per policy period, just for getting your bills via email and having the payment automatically deducted from your bank account. Why? It saves them money on postage and processing, and it guarantees you pay on time. It's free money. Take it. Next, the new car discount. This sounds backward, right? A newer car is more expensive to replace, so it should be more expensive to insure. Not always. Insurers offer this because cars that are less than 3 years old are statistically safer. They have the latest safety features and are less prone to mechanical failures that can cause an accident. If your car is a recent model year, make sure you're getting credit for it. Here is a huge one that almost nobody knows to ask for, the homeowner discount. This is different from the multi-policy bundle. Some companies will give you a discount on your auto insurance just for being a homeowner, even if your home is insured with a completely different company. The data shows that people who own their homes tend to be more financially stable and are statistically less risky drivers. It's a correlation that works in your favor. You have to ask for it specifically. I own my home. Does that qualify me for a separate homeowner discount on my auto policy? The silence you might get on the other end of the phone is the sound of an agent realizing you've done your homework. And the last obscure gem is the early shopper or advanced quote discount. Insurance companies love stability. They get nervous when people shop for insurance the day before their policy expires. It signals desperation or poor planning. But if you shop for your quote 8 to 15 days before your current policy's renewal date, many companies will give you a discount. It shows you're a responsible planner, which is exactly the kind of customer they want. So don't procrastinate. Mark your calendar 2 weeks before your renewal and start shopping then. There you have it. A comprehensive list of discounts that goes far beyond the basics. We've covered everything from your car's resume to your professional affiliations to the simple act of owning a home. But knowing the discounts is only half the battle. The real magic, the real savings, comes from how you stack these discounts, how you present your case to the insurance company, and what you do when you have a less than perfect record. What if you have a ticket? Or an at-fault accident? Are you just doomed to pay high rates forever? Absolutely not. There's a strategy for that too. And that's exactly what we're going to break down next. How to negotiate and structure your policy for the absolute maximum savings, even if your driving record isn't squeaky clean. The first thing you need to understand is that an insurance policy isn't a fixed product you buy off a shelf. It's not like a gallon of milk or a box of cereal where the price is the price. Think of it more like a custom-built computer or a tailored suit. You get to choose the components, You decide the level of quality for each piece, and the final price is a direct result of those choices. Most people just accept the first prepackaged bundle an insurance company offers them. But the power users, the people who are saving hundreds, even thousands of dollars a year, they treat it like an a la carte menu. They are actively building their policy piece by piece. So let's open up the blueprint. The first and most important component you control is your liability coverage. This is the part of your policy that pays for the other person's injuries and property damage if you cause an accident. In Florida, the state minimums are shockingly low. Just $10,000 for property damage and $10,000 for personal injury protection, which we'll get to. But here's the trap. Just because it's the legal minimum doesn't mean it's the smart choice. Imagine you cause a fender bender that totals a brand new $50,000 SUV. Your $10,000 minimum property damage limit is exhausted instantly. Who pays the other $40,000? You do. Out of your pocket. Your savings, your assets, they could even garnish your future wages. It's a financially catastrophic scenario. So, while choosing the state minimum is the fastest way to see a low premium on the screen, it's like building a house with a cardboard foundation. The secret to structuring your liability for savings isn't about going as low as possible. It's about finding the sweet spot. Look at coverage levels like 25/50/25. That means $25,000 for bodily injury per person, $50,000 per accident, and $25,000 for property damage. For many drivers, this provides a much safer cushion without dramatically increasing the price. Go up to 50/100/50. See what the price difference is. You might be shocked to find that doubling your protection doesn't double your premium. Sometimes it's only a few dollars more a month for an exponentially larger safety net. The key is to ask for quotes at several different levels. Don't just accept the default. You are in control of this variable. Now let's talk about the part that covers your car. Collision and comprehensive. Collision pays to repair your car after an accident you cause. Comprehensive covers theft, vandalism, hail, hitting a deer, basically things that aren't a traditional crash. The most powerful lever you can pull here is your deductible. The deductible is the amount you pay out of pocket before the insurance company pays a dime. Insurance companies love high deductibles. A driver willing to take on a $1,000 deductible is seen as a lower risk than someone who wants a $250 deductible, and they price the policy accordingly. The difference in your 6-month premium between a $500 and a $1,000 deductible can be substantial. So here's the strategy. Look at your savings. Do you have at least $1,000 you could comfortably access in an emergency? If the answer is yes, getting a quote with a higher deductible is one of the single fastest ways to slash your premium. You're essentially betting on yourself to be a safe driver, and the insurance company will reward you for taking on a little more of that initial risk. But there's another side to this coin. When should you get rid of collision and comprehensive altogether? The rule of thumb is based on your car's actual cash value. If your car is an older, paid-off vehicle worth, say, $3,000, and your deductible is $1,000, the absolute maximum the insurance company would ever pay out is $2,000. Now look at your bill. How much are you paying every 6 months just for the collision and comprehensive portion? If you're paying $500 every 6 months, $1,000 a year, to protect a potential $2,000 payout, you're on the losing end of that math. After just 2 years, you will have paid the insurance company the exact amount they would have ever paid you in a total loss claim. So get your car's value from a site like Kelley Blue Book. Look at your policy statement and do the math. Dropping this coverage on an older car can cut your bill in half overnight. Next, let's tackle the Florida-specific stuff. Personal injury protection, or PIP, and uninsured motorist coverage, or UM. PIP is mandatory. It covers your own medical bills up to $10,000, regardless of who was at fault in an accident. Because it's required, you don't have a ton of wiggle room here, but you can sometimes choose your PIP deductible. Just like with collision, opting for a deductible of, say, $500 or $1,000 on your PIP can lower your premium. But be careful. This means if you get into an accident, you're on the hook for that first chunk of your own medical bills. This is a trade-off you need to seriously consider based on your health insurance and your emergency fund. Uninsured motorist coverage, however, is optional. And this is where the insurance agent's phone call gets tricky. They'll tell you it's to protect you from the huge number of uninsured drivers on Florida's roads. And they are not wrong. UM coverage pays for your injuries if you are hit by someone with no insurance or not enough insurance. It is incredibly important coverage, but it also costs money. So, how do you structure this for savings? First, you must sign a form to reject it, so you'll be forced to confront the decision. Don't just automatically say yes. Look at your own health insurance policy. What's your deductible? What's your out-of-pocket max? If you have a fantastic health insurance plan with low out-of-pocket costs, you might be able to opt for a lower level of coverage, or in some rare cases, reject it entirely, knowing your health insurance is your primary safety net for medical bills. But if an accident puts you out of work, can also cover lost wages, which health insurance won't. It's a complex, personal decision. The key is not to just accept the default. Price it out. See what $50,000 in coverage costs versus $100,000. Make an informed choice, don't just let it be chosen for you. Now, what about that imperfect driving record? Let's say you have a speeding ticket or an at-fault accident on your record. You feel like you have no power. You're at the mercy of the insurance companies. This is not true. Your leverage is simply different. First, understand the timeline. Most minor violations, like a speeding ticket, will only significantly impact your rates for 3 years. Major violations, like a DUI, can affect them for 5 years or even longer. Knowing this timeline is your first piece of power. It means your high rates are temporary. You can set a calendar reminder for 3 years from the conviction date of that ticket to aggressively reshop your insurance, because you will no longer be in that high-risk bracket. In the meantime, you need to be proactive. The single best thing you can do is take a state-approved defensive driving course. Yes, it costs a little money and a Saturday afternoon, but many insurers in Florida offer a significant discount for completing one. It's you showing the insurance company, "I know I made a mistake, and I have taken concrete steps to become a safer driver." That's a message they will listen to in the language they understand best. Discounts. When you call for a quote, don't wait for them to ask. You lead with it. "I'm looking for a new policy. I should mention I have a ticket from 2 years ago, but I have since completed a defensive driving course and have had a perfect record since. What's the best rate you can give me?" You're framing your past mistake as a learning experience, not as a pattern of behavior. Finally, the most powerful negotiation tactic of all is also the simplest. Have other offers in hand. Never ever take the first quote you get. Go through the entire structuring process we just discussed with at least 3 different companies, one captive agent like State Farm, one independent agent who can shop multiple carriers, and one online-first company like Progressive or Geico. Get a detailed, written quote from each one. Now, you can go back to the company you want to be with and say, "I'd love to sign with you today, but I have a quote here from your competitor for the exact same coverage, and they're coming in $60 cheaper for the 6-month term. Is there anything you can do to match that?" You've just turned the tables. You are no longer a customer asking for a price. You are a valuable asset they are about to lose to a direct competitor. You would be amazed how often a manager can suddenly find a special discretionary discount to close the deal. This works even with a bad record. Because even in the high-risk pool, companies are still fighting for your business. By structuring your policy deliberately and negotiating from a position of knowledge, you take back control, turning a frustrating expense into a calculated financial decision. But that control extends beyond just the numbers on your policy declaration page. It's about understanding a fundamental truth that most people miss when they shop for insurance. You aren't just buying a piece of paper. You're not just buying a promise. You are hiring a company to perform a critical, time-sensitive, and financially massive job for you at a future unknown date. The price you pay is their salary. And just like hiring an employee, choosing the cheapest candidate without checking their references or their track record is a recipe for disaster. Think about it this way. You're about to go skydiving. There are 2 companies on the airfield. One offers a jump for $200, using new meticulously maintained equipment, with instructors who have thousands of jumps under their belts. The other company offers the same jump for $50. Their parachute packs look a little worn. Their instructor seems distracted. Which one are you choosing? You're picking the first one every single time, because you understand that the value isn't in the fall, it's in the landing. The price reflects the quality and reliability of the outcome. Auto insurance is the financial equivalent of that parachute. The premium is the price of the jump, but the claims process, that's the landing. And in Florida, with our crowded roads, unpredictable weather, and complex legal environment, you need to be absolutely certain your parachute is going to open. This is where we move beyond the quote and into the company itself. We need to evaluate 3 core pillars of any insurance carrier: their claims handling, their customer service, and their financial stability. Let's start with the most important one, the claims process. This is the moment of truth. This is the one and only reason you pay them money every month. Everything else is just administrative. When you have an accident, will they be a partner or an obstacle? Picture this scenario. Two drivers, let's call them Alex and Ben, get into the exact same not-at-fault accident on I-95. A tourist in a rental car runs a red light and T-bones both of them. Both cars are seriously damaged and both drivers are shaken but okay. This is where their stories diverge dramatically. Alex chose his insurance based on one factor: the absolute lowest price he could find online. He's with a company he'd never heard of, but it was $60 a month cheaper than the next best quote. He calls the 800 number on his insurance card. He spends 45 minutes navigating an automated phone tree, only to be put on hold for another 20. When he finally gets a human, they sound like they're in a crowded call center 1,000 miles away. They take his information and tell him an adjuster will call him back within 72 hours. 3 days go by. No call. His car is sitting in a tow yard racking up storage fees. He calls back, goes through the whole phone tree and hold process again, and finally gets someone who says his claim was assigned, but the adjuster is very busy. They can't authorize a rental car until the adjuster inspects his vehicle and determines fault, even though the police report clearly states the other driver was 100% at fault. Another 2 days pass. The adjuster finally calls, is short with him, and schedules an inspection for late next week. By the time they finally accept liability, approve the repairs, and offer him a check, it's been 3 weeks. He's been forced to Uber everywhere, costing him hundreds of dollars. The body shop tells him the insurance company's payment is too low and doesn't cover the cost of original manufacturer parts, forcing him to either pay the difference or use cheaper, aftermarket parts. The entire process is a soul-crushing, stressful fight, all to save $60 a month. Now let's look at Ben. He pays a bit more for a well-known, reputable insurer. He has their app on his phone. While still at the scene of the accident, he opens the app, starts a claim, uploads photos of the damage and the police report, and requests a tow truck, all in about 10 minutes. Before the tow truck even arrives, he gets a call from a dedicated claims representative based in Florida. She confirms all the details, expresses her sympathy, and tells him she's already arranged for a rental car to be waiting for him at the Enterprise down the street. She has a list of pre-approved, high-quality body shops in his area, and tells him to have the car towed to whichever one he prefers. She assures him they will handle everything directly with the shop. The next day, the body shop calls to say the insurance adjuster has already approved the full repair estimate using OEM parts. Ben is in his rental car going about his life. 2 weeks later, the shop calls to say his car is ready, good as new. The insurance company paid the shop directly. Ben just signs a form and drives away. The entire process was seamless, professional, and stress-free. He paid a premium not just for a policy but for peace of mind. He hired a professional to do a job, and they did it flawlessly. That story is the difference between a good insurer and a bad one. And you don't know which one you have until it's too late. So how do you find out beforehand? You do your homework. You check the references. One of the best resources for this is the J.D. Power U.S. Auto Insurance Study. Every year, they survey tens of thousands of real customers and rank insurance companies based on overall satisfaction, billing, and, most importantly, the claims process. A company that consistently ranks at the top in the Florida region is a very good sign. The second pillar is customer service. This is the day-to-day stuff. What happens when you need to add a new car to your policy, or remove a driver, or simply ask a question about your bill? Is it a 10-minute pleasant chat with a knowledgeable agent who knows your name? Or is it a descent into the seventh circle of call center hell? Bad customer service is a massive red flag. If a company can't handle a simple billing inquiry efficiently, how on earth do you expect them to handle a complex, multi-thousand-dollar collision claim? Read online reviews, but do it with a critical eye. Ignore the one-off rants. Look for patterns. If you see dozens of reviews all saying the same thing, "I can never get a human on the phone," or "they messed up my automatic payments 3 times," that's not an anecdote, that's data. The final pillar, and this is critically important in Florida, is financial stability. Our state is a battlefield for insurers. Hurricanes can wipe a company out overnight. We've seen a shocking number of Florida-based insurers go insolvent, go bankrupt, in just the last few years. If your insurance company goes under, your policy is worthless. You could be in the middle of a major claim, and suddenly there's no one there to pay the bill. You need to know if the company you're trusting with your financial security actually has the money to back it up. Thankfully, you don't have to be a Wall Street analyst to figure this out. Independent agencies rate the financial strength of insurance companies. The most well-known is AM Best, but for many Florida-specific companies, you'll see a rating from Demotech. These agencies look at a company's balance sheet, their cash reserves, and their ability to pay claims, especially after a catastrophe. They issue a simple letter grade like a report card. An A rating is excellent. A B is okay. Anything lower, or a company that is unrated, should be a massive warning sign. You can typically find these ratings right on the insurance company's website because if they have a good one, they're proud of it. If you can't find it, that's also a red flag. Another powerful tool at your disposal is the National Association of Insurance Commissioners, or NAIC, Complaint Index. This is a brilliant metric. The NAIC tracks the number of confirmed complaints filed against an insurer and compares it to their market share. They create a national median score of 1.0. A company with a score of 2.0 has twice as many complaints as you'd expect for its size. A company with a score of 0.5 has half as many. You want to see a number at or ideally well below 1.0. You can look this up for free on the NAIC website. It is one of the most direct, unbiased indicators of how a company actually treats its customers. So, when you're gathering quotes, you're now doing more than just looking at the price. You're building a dossier. For each company that gives you a competitive quote, you're opening new tabs. You're checking their J.D. Power ranking. You're looking up their NAIC complaint index. You're confirming their AM Best or Demotech financial rating. You're looking for patterns in customer reviews. This is how you find true value. The goal is not the rock-bottom cheapest premium. The goal is the lowest possible premium from a company that has a proven, documented history of excellent claims service, responsive customer support, and ironclad financial stability. Finding that intersection is the key. It's how you ensure that when you need it most, your parachute will, without a doubt, open. You're no longer just a price shopper. You're an informed consumer making a critical financial decision for your family's protection. And becoming an informed consumer is about understanding the stories behind the numbers. Let me tell you about a guy named Mark from Kissimmee. Mark was smart, a hard worker, and like most of us, he was trying to save a buck wherever he could. He got his renewal notice from his auto insurer, and the price had jumped again. Frustrated, he spent an evening online, plugging his info into a dozen different quote generators. One came back shockingly low, almost too good to be true. It was a company he'd barely heard of, but the price was $100 less per month. He didn't pore over the policy documents. He didn't call and ask questions. He saw the dollar sign, felt the rush of saving $1,200 a year, and he clicked purchase. He felt like he just won the lottery. For 6 months he did. That $100 went back into his budget, easing the pressure. He felt savvy. Then came a Tuesday afternoon on I-4, just east of the 417 interchange. A sudden torrential Florida downpour. Visibility dropped to near zero. Traffic slammed to a halt. Mark did his best, but his tires hit a slick patch, and he slid ever so slowly into the back of a brand new Lexus SUV. It didn't seem that bad. A crumpled bumper on his car, a dent and some deep scratches on the Lexus. No one was hurt, thank God. They exchanged information. Mark wasn't too worried. This is what insurance is for, right? The first sign of trouble came a week later. The body shop estimate for the Lexus was over $9,000. The intricate sensors and cameras embedded in its rear bumper were astronomically expensive to replace and recalibrate. Mark checked his policy. His property damage liability limit, the part that pays for the other person's car, was capped at $10,000. That was the Florida state minimum. He breathed a sigh of relief. Close, but he was covered. But then the second letter arrived. It was from an attorney. The driver of the Lexus, it turned out, was a surgeon. The jolt from the accident, while seemingly minor, had aggravated a pre-existing neck condition. He was claiming he couldn't perform surgery for the next 3 months. He was claiming lost wages, pain and suffering, and ongoing physical therapy. The total demand was for $150,000. Mark pulled up his policy again, his hands trembling this time. He scrolled to the bodily injury liability. It read 10/20ths. $10,000 per person, $20,000 per accident. He had $10,000 of coverage for a $150,000 claim. That cheap policy he was so proud of? It was a ghost. A phantom. It covered the bare minimum to be legal, but in the face of a real-world, everyday accident, it evaporated. The insurance company paid out its $10,000, wished him luck, and closed the file. Mark was now personally on the hook for the remaining $140,000. The savings he celebrated were a drop in the ocean of debt he now faced. His wages could be garnished. A lien could be placed on his home. The $1,200 he saved in a year cost him his entire financial future. Mark's story isn't a scare tactic. It is the reality of what happens when price is the only thing that matters. So how do you avoid this? How do you understand the forces that are secretly shaping that price quote you see on the screen, so you can find the balance between affordable and adequate? You have to look under the hood. You have to understand the hidden architecture of your insurance rate. There are 4 invisible factors that have a massive impact on your premium that most people completely overlook. The first is your credit-based insurance score. Now hold on. This is not the same as your FICO score that a bank uses for a mortgage, though they are related. Insurance companies have found, through mountains of data, a strong statistical correlation between how a person manages their financial affairs and how likely they are to file a claim. It's not about how much money you have. It's about financial responsibility. Do you pay your bills on time? How much debt are you carrying? How long is your credit history? They take this information and generate an insurance score. In Florida, this is a huge rating factor. Someone with a poor insurance score can pay double or even triple what someone with an excellent score pays for the very same coverage with the very same driving record. What does this mean for you? It means that improving your credit score, paying down credit cards, making payments on time, isn't just good for getting a loan. It's one of the most powerful long-term strategies for lowering your auto insurance costs. The second hidden factor is your specific hyperlocal zip code. You might think, I live in Tampa, so I pay Tampa rates. But it's far more granular than that. Insurers break down risk by individual zip codes, and sometimes even smaller census tracts. They know the exact accident frequency at the intersection a mile from your house. They have data on the number of vehicle thefts, incidents of vandalism, and even the prevalence of insurance fraud in your specific neighborhood. You could live in one zip code, and your friend 5 miles away in another could have a significantly different rate, even if everything else is identical. This is why you must update your address with your insurer every time you move, even if it's just across town. That move could unlock a surprise discount, or conversely a rate increase you need to be aware of and shop for. You're not just being insured in a city, you're being insured on your specific block. The third factor is the deep data on your specific vehicle. Yes, you know a Porsche costs more to insure than a Honda Civic, but it goes so much deeper. Insurers have access to incredibly detailed databases. They know the exact cost of the most commonly replaced parts on your 2019 Toyota Highlander. They know its specific crash test ratings from the Insurance Institute for Highway Safety. They know its theft rate. Is it on the top 10 list of most stolen vehicles in Florida? They also factor in the complexity of repairs. A car loaded with advanced driver assistance systems, lane keep assist, adaptive cruise control, pedestrian detection sensors, is safer and can prevent accidents. But as Mark discovered, if those systems get damaged, the cost to repair and recalibrate them is enormous, and your collision and property damage rates will reflect that. Look up your car's safety ratings and repair cost data. Knowing your car's risk profile helps you understand the why behind your premium. Finally, the fourth hidden factor is the nuance of your driving history. We all know tickets and accidents raise our rates, but insurers see it with more detail. A speeding ticket for going 10 miles over the limit is viewed differently than one for 30 miles over. A conviction for reckless driving or a DUI is a catastrophic event for your insurance premium, potentially lasting for 5 to 7 years. Insurers look at the look-back period, how long ago the incident occurred. In Florida, a minor violation might only impact your rates for 3 years, while a major one sticks around for much longer. They also look at frequency. 1 ticket in 5 years is one thing. 3 tickets in 2 years paints a picture of a high-risk driver. The takeaway here is to treat your driving record like a resume. You want to keep it as clean as possible. And if you do get a minor ticket, it is almost always worth it to elect to take a defensive driving course. In Florida, this can prevent the points from being added to your license, effectively making that ticket invisible to your insurance company and saving you from a multi-year rate hike that will cost you far more than the price of the course. Understanding these 4 elements, your insurance score, your hyperlocal zip code, your vehicle's data profile, and the nuances of your driving record, is like being handed the secret playbook. You're no longer a passive customer accepting a price. You're an active participant who understands the forces at play. You now see why a quote can seem random or unfair. It's not. It's a complex calculation based on these hidden data points. And knowing this is the first step to taking control. So let's take it. Let's weaponize that knowledge. Because understanding the algorithm is one thing. Learning how to make that algorithm work for you is something else entirely. This is where we move from theory to action, from being a student of the game to becoming a player who can actually win. And the single most powerful weapon in your arsenal, the one action that will save you more money than any other, is deceptively simple. You have to shop around. I know. Sounds painfully obvious. But the data is shocking. Millions of Floridians stick with the same insurance company for years, even decades, under the mistaken belief that they're being rewarded for their loyalty. This is one of the biggest and most expensive myths in personal finance. In the insurance world, loyalty is often punished, not rewarded. There's a quiet industry-wide practice sometimes called price optimization, or, more bluntly, a loyalty tax. It's based on a simple cold calculation. The longer you've been a customer, the less likely you are to go through the hassle of shopping for a new policy. So your rates creep up. 5% one year, 7% the next. It's never a huge, shocking jump that would make you angry enough to leave. It's a slow, methodical bleed designed to be just under your radar. The company is betting on your inertia. They're betting you won't make the call. Our job is to make them lose that bet. So how often should you shop? The simple answer is at every single renewal period. At least once a year, you need to put your insurance company on trial. Make them re-earn your business. But there are other critical trigger points that should send you straight to the marketplace. Any major life event is a signal. Did you just get married? That's a huge one. Insurers see married individuals as more stable and less risky, often resulting in a significant discount. Did you move? Your zip code is a massive rating factor. Moving just a few miles can drastically change your premium, for better or for worse. You need to know which. Did you buy a house? This opens up the holy grail of discounts. The home and auto bundle. Did your commute change? If you're now working from home instead of driving 40 miles a day, your insurer needs to know, and your rate should plummet. And here's one most people forget. Check your calendar. Has it been 3 years since that speeding ticket? 5 years since that minor fender bender? Once those incidents fall off your record, it's like they never happened in the eyes of the insurance raters. This is a massive opportunity for a rate reduction, but your current company has no incentive to automatically give it to you. You have to go out and get quotes from competitors who will see you as a clean slate. The same goes for your credit score. If you've spent the last year paying down debt and your score has jumped 50 points, you are now a different, more attractive customer. It's time to get quotes that reflect that. Okay, so you're ready to shop. Where do you go? You have 3 main paths and each has its pros and cons. Path 1 is going direct to the carriers. This means sitting down and filling out online quote forms for Progressive, Geico, State Farm, Allstate, and so on one by one. The upside is that you're dealing directly with the company. The massive downside is that it is incredibly time-consuming, and you're only getting a tiny snapshot of the market. There are over 100 insurance companies writing auto policies in Florida. You might spend an entire afternoon getting 5 quotes and completely miss the company that would have saved you $1,000. Path 2 is the captive agent. This is your local State Farm or Allstate agent, for example. They are an expert on one company's products. They can be incredibly helpful and knowledgeable, but their toolbox is limited. They are captive to that one brand. They can't turn to their computer and say, you know what, Progressive actually has a much better rate for you this year. Their job is to sell you their company's policy. It's a conflict of interest that is baked into their business model. This brings us to path 3, and in my experience, it is the single most effective strategy for the average person. Using an independent insurance agent or broker. This is the game changer. An independent agent doesn't work for an insurance company. They work for you. Their loyalty is to you, their client. They represent dozens of different insurance companies, from the big national names to smaller, regional carriers you've never even heard of. They take all your information once, and then they do the shopping for you, running your profile through their system to see which of their many carriers offers the best combination of coverage and price. They can compare 20, 30, even 40 companies in the time it would take you to get 2 quotes online. They know the market, they know which companies are competitive for drivers with your specific profile, and they can give you advice that isn't biased toward a single brand. But to use any of these paths effectively, you need to be prepared. The key to a successful shopping experience is having your declaration page from your current policy. This is the single most important document. It's usually the first or second page of your policy packet, and it's your personal cheat sheet. It lists every single coverage you have, your liability limits, and your deductibles for collision and comprehensive. When you get new quotes, your first step is to get an exact apples-to-apples comparison. You hand them your declaration page and say, "Quote me for this. Exactly this." This gives you a pure baseline for price. If Company A is $800 for 6 months and Company B is $1,100 for the exact same coverage, you have a clear winner on price. Only after you've established that baseline should you start discussing changes. Maybe you want to increase your liability limits or lower a deductible. But starting with an apples-to-apples comparison is the only way to know if you're actually getting a better deal. And please do not make the catastrophic mistake of only looking at the price. The cheapest policy is often the worst. A few dollars saved now could cost you your entire life savings after a serious accident. This is where you need to do a little homework. Ask the agent about the company's claim satisfaction record. Look up their financial strength rating from a service like AM Best. You want a company that is going to be there with a check in hand when you need them most. A great independent agent will guide you here, steering you away from companies with a reputation for poor service, even if they're a few bucks cheaper. Finally, let's talk about two of the most critical decisions you will make when shopping for insurance in Florida. The first is uninsured motorist, or coverage. Florida has one of the highest rates of uninsured drivers in the entire country. The statistics say about 1 in 5 drivers on the road with you has no insurance at all. Think about that. The next time you're on I-95, look at the 4 cars around you. Statistically, one of them is illegally uninsured. If that person slams into you and puts you in the hospital, their non-existent insurance policy isn't going to pay for your medical bills, your lost wages, or your pain and suffering. That's where coverage steps in. It is insurance that you buy to protect yourself from the irresponsible and illegal actions of others. It is, without a doubt, one of the most important coverages you can carry in this state. Waiving it to save a few dollars a month is one of the riskiest financial gambles you can possibly make. The second is stacking. If you have more than one car on your policy, Florida law allows you to stack your uninsured motorist coverage. For example, if you have $100,000 in coverage in 2 cars, stacking it essentially doubles your available coverage to $200,000 for a relatively small increase in premium. If you're ever seriously injured by an uninsured driver, that decision to stack your coverage could be the difference between a full recovery and financial ruin. You are now armed with a strategy. You know when to shop, where to go, and what to ask for. You understand that you're not just buying a price, you're buying protection, and that requires a thoughtful, proactive approach. You're ready to take control of the process and force the companies to compete for your business. But what happens after you've found that perfect policy? What do you do when the worst actually happens? How do you navigate the chaos and confusion of an auto accident and ensure you use that policy to your full advantage? In our final part, we'll walk you through the anatomy of a claim step by step, so you know exactly what to do in the critical moments after a crash to protect yourself and your financial future. The sound of crunching metal and shattering glass is a sound you never forget. Your heart pounds in your chest, adrenaline floods your system, and 100 thoughts race through your mind at once. Is everyone okay? What just happened? What do I do now? This is the moment where all the research, all the comparison shopping, and all the premium payments are put to the ultimate test. This is where your insurance policy transforms from a piece of paper into a financial lifeline. First, before anything else, take a deep breath. Check on yourself and your passengers. If anyone is injured, your first and only priority is to call 911 immediately. Do not move anyone who is seriously hurt unless they are in immediate danger, like from a fire. Your car can be replaced. People cannot. Assuming everyone is okay and the accident is minor, the very next step is to secure the scene. If it's safe and your car is drivable, move it to the shoulder or a nearby parking lot to get out of the flow of traffic. Turn on your hazard lights. This isn't just a courtesy. It's about preventing a second, potentially worse, accident. Now let's talk about what you say and, more importantly, what you don't say. The adrenaline is pumping, you might feel shaken, you might even feel guilty. It is human nature to say, "I'm so sorry, this was all my fault." Do not do this. Never, ever admit fault at the scene of an accident. You're not a claims adjuster or a police officer. You're in shock and you don't have all the facts. A simple, "Are you okay?" is all that's needed. Stick to the facts only. Your smartphone is now the most important tool you own. Become a detective. Take photos of everything, and I mean everything. Get wide shots of the entire scene showing the position of the cars. Get medium shots of the damage to both vehicles. Get close-ups of the specific points of impact. Photograph the other driver's license plate, their driver's license, and their insurance card. It's much faster and more accurate than trying to write it all down. Look for skid marks on the road, traffic signs, weather conditions, anything that helps tell the story of what happened. If there are witnesses, politely ask for their names and phone numbers. A neutral third-party account can be invaluable. Should you call the police for a minor fender bender? In Florida, the law requires you to report a crash if there's an injury, a death, or apparent property damage of $500 or more. A broken headlight and a dented bumper can easily exceed $500 today. So the answer is almost always yes, call the police. The police report is a critical piece of objective evidence that your insurance company will use to determine fault. Once the scene is secure and the police have been called, it's time to call your insurance company. Many insurers have a 24/7 claims hotline or a feature in their mobile app to start the process right there on the spot. This is the moment you've been paying for. When you make that call, have your policy number ready. Be prepared to provide the date, time, and location of the accident, a basic description of what happened, the other driver's information, and the police report number if you have it. Again, stick to the facts. Don't speculate, don't guess, and don't offer opinions on fault. Just state what you know. I was traveling north in the right lane. The other vehicle entered my lane and the front passenger side of my vehicle made contact with the rear driver's side of theirs. This is a factual statement. He came out of nowhere and swerved right into me because he was probably texting. Is a speculative, emotional statement. See the difference? After this initial call, you'll be assigned a claims adjuster. This person is your primary point of contact. Their job is to investigate the claim, determine who is at fault, and figure out how much the insurance company is obligated to pay based on your policy. They will likely ask you for a more detailed recorded statement. It's perfectly okay to say you'd like to have your notes in front of you for that call. Take your time and be consistent with the facts you provided at the scene. Now let's talk about your car. Your adjuster will guide you on getting a damage estimate. You have the right in Florida to take your car to the repair shop of your choice. Your insurance company might have a network of preferred shops, which can sometimes streamline the process, but they cannot force you to use one. Get a detailed, itemized estimate from the shop. The adjuster will review it, possibly negotiate with the shop, and then approve the repairs. This is where your collision and comprehensive coverages come into play. If you have collision coverage, your policy will pay for the repairs to your car, minus your deductible, regardless of who was at fault. If you aren't at fault, your insurance company will then try to recover the costs, including your deductible, from the other driver's insurance company through a process called subrogation. If they're successful, you get your deductible back. This can take time, but it's a fight your insurer handles for you. What about injuries? This is where Florida's no-fault system in your personal injury protection, or PIP, coverage is critical. Remember how we said everyone needs it? Your PIP coverage is your primary source for medical payments after a crash, covering 80% of your initial medical bills up to $10,000, no matter who caused the accident. You must seek initial medical treatment within 14 days of the accident for your PIP benefits to apply. This is a hard deadline, so even if you feel just a little sore, get checked out by a doctor. Adrenaline can mask serious injuries. If your injuries are severe and the costs exceed your PIP coverage, and the other driver was at fault, that's when their bodily injury liability coverage kicks in. This is why we stress the importance of carrying more than the state minimum. If you were the one at fault and you injured someone else, your bodily injury coverage protects your assets from a potential lawsuit. All those decisions you made when you bought your policy, they come to life right here. The entire claims process can feel slow. It involves adjusters, appraisers, repair shops, and potentially medical providers. Be patient, but also be proactive. Keep a log of every conversation, who you spoke to, the date, and what was discussed. Don't be afraid to follow up with your adjuster for updates. Be polite, but be persistent. Once the investigation is complete, and the costs are calculated, you'll receive a settlement offer. For vehicle damage, this is straightforward. It's the cost of repairs. If your car is declared a total loss, the settlement will be for the actual cash value, or ACV, of your car right before the accident. This is what it was worth considering depreciation, not what you paid for it or what a new one costs. For injuries, the settlement can be more complex, covering medical bills, lost wages, and potentially pain and suffering. Through this entire journey, from understanding Florida's unique laws in Part 1 to finding every last discount in Part 7, we've given you the tools not just to find a cheap policy, but to build the right policy. A policy that acts as a fortress around your financial life. Finding affordable auto insurance isn't about a single secret trick. It's about understanding the system. It's about knowing that your credit score matters, that your zip code has an impact, and that loyalty isn't always rewarded. It's about having the confidence to shop around, to ask tough questions, and to demand the value you deserve. It's about knowing the difference between PIP and bodily injury liability, and why having both is so crucial. And now you know what to do in the most stressful moment of all, the aftermath of a crash. You know to stay calm, to document everything, to avoid admitting fault, and to let the policy you so carefully built do its job. You are no longer just a driver. You are an informed consumer. You are in control. Take 15 minutes this week, pull out your current policy declaration page, and look at it with new eyes. Do you have the coverage you need? Are you getting the discounts you've earned? You now have the knowledge to answer those questions and the power to make a change. Drive safe, stay covered, and thank you for taking this journey with us.